Hey guys, welcome back to another stream. So, Stonks Maxxing day 54. Title, still confused on convexity. It's a bit misleading because it's still confused on duration as well, but I think confused on convexity, there's a bit of alliteration there, so rolls off the tongue better. But what I want to do for this stream is maybe take a look at some of the examples that we went over yesterday. And yesterday we did focus mainly on understanding the concept of duration. So right here, I have 4 different bullet points, and these are just the different definitions of duration I've heard. So interest rate risk, you can think of duration as how risky a bond is to changes in to changes in interest rate. So let me say that one more time. How sensitive a bond's price is relative to changes in market interest rates. Market interest rates usually can be thought of as target federal funds rates, which is really highly correlated with the effective federal funds rate, which is what people being banks, lend to each other on an overnight basis, I believe. Now, the second definition I've heard, and I think this really goes to the idea of Macaulay duration, and this is the present value weighted average time until maturity. So this is more of a mathematical definition. Yeah, I don't know if it actually has any substance to it, but from a mathematical point of view, the way you can think about the present value weighted, so you can think of it as 2 vectors. A vector with weights and a vector with the time or the period. And the vector of weights can be calculated as we take the present value of a cash flow for some period and we divide that by the present value of the bond or the price of a bond. Now, on the other side, we have our period. So this is a vector of our periods, and I think the way you can express this can be dependent on the way your yields are expressed, I believe. So let me try to think about this, right? Okay, so I think what I mean by that, when the periods sort of reflect the coupon payments. So let's say this, you have a bond paying coupons semi-annually. So that's twice a year. Then the period, let's say it's a bond that matures in 2 years. We can express our period vector in, I think, 2 different ways, right? One way, I think, is by taking each semi-annual period. So that's half a year, 1 year, 1.5 years, and 2 years. Stick that into a vector so that becomes something like this. 1, so 0.5, 1, 1.5, 2. And then we have another vector where a coupon is the semi-annual coupon. So let's say our annual coupon is equal to 5%. Let's make it 6% to make it even. And our semi-annual coupon is equal to 3%. Then we also have the idea of market interest rates. So you can think of market interest rates as a discount rate or a yield to maturity. So that's really just the discount or the denominator for discounting or finding the present value of your cash flows. Yeah, I said discount maybe a few too many times. Okay, so let's say we have yield to maturity. It's equal to 6%. Then our semi-annual yield to maturity is equal to 3%. So same exact thing here. And by doing this, I believe we can take each coupon at 3%. So 3% par is equal to 100. 3% of 100, that's $3. Then each cash flow, we just take $3, divide that by 1 plus 3%, and then we then raise that to whatever this number here is. So this is 0.5. Yeah, and I think we could do this 4 times. So we get 4 cash flows, and we have to make sure that in the 4th cash flow, we also include the par or the principal amount. Yeah, okay, I think that's the right track so far. That's kind of basic bond theory. So that's the idea of Macaulay duration, the present value weighted average time until maturity. And so one key thing before I go to the next definition with Macaulay duration is if you have changes in interest rates. So that means your price is going to change. If your interest rates fall, then your price is going to rise. You can think of it as if your interest rates fall, the discount rate gets smaller. So if your discount rate gets smaller, then the opportunity cost or the risk-free rates, the actual return that you would get for investing in a treasury bill is less. And so that means your cash flows being valued today for something that's received in the future is going to be more valuable. Yeah, that was maybe that's a great definition, but long story short, you have cash flows in the future that are being discounted at a smaller rate, so they're going to be more valuable. And because your cash flows are more valuable, those cash flows are going to represent a higher price for your bond. Okay, so those probably part 2 of the fundamentals. And bringing that back to the conversation with Macaulay duration. So changes in interest rates will affect the price, but it shouldn't affect the weight. So this thing right here, each present value weight, one key thing here I forgot was to divide this by the price of the bond. So each present value weight here is constant. It doesn't change with respect to the price. And I think yeah, I want to say the reason why is because it's proportional. Let me think about it this way. So this is where I was stuck on with this, proving this relationship. So I'll come back to this. There's one thing I just thought of so far. If you take the ratio, what happens? Okay. Could help with standing Macaulay duration. Okay, yeah, that's good. Now, let's just go on to the third one. Change in price relative to change in market interest rates, assuming linear relationship. Yeah, I think what I mean here is duration, you can think of it as if market interest rates were to move 1%, let's say upwards, then that means your price of your bond is going to decrease by the duration. So let's say duration is 3, bond is currently priced at 100, market interest rates rise 1%. That means your bond is going to decline by, I believe, 3 points or $3. maybe even 3%. I'm not too sure if it's a percentage or if it's a dollar amount, so I should probably get back into that. Is this a percent? Maybe a percent of par. So I think it would be 97% or $97. Yeah, and I think the last definition is it's the first derivative of the price yield curve. So this is what the price yield curve looks like. This right here represents really the duration of a bond. So this straight line here, and this right here refers to the idea of convexity, which is the second. Now, what this thing here kind of represents, I think, is two types of bond payoffs. So that's before I even get into the idea of convexity. You have something that looks like a smiley face, and this is, I think, what's called a convex payoff. You'll notice that as bond yields fall, the price of a convex payoff actually increases faster than just a linear payoff. So I think as an investor, I definitely would want a bond where I could get a higher price if yields fell, and on the flip side, I could get a lower price or a lower decrease when yields rise. And so you can think of this as kind of the inverse relationship again between yields and price. But you'll see here that as bond yields rise, then the actual bond price declines a lot faster than a convex bond price. So I think this then goes into the idea of convexity. So this is the idea, this is the thing that makes most sense to me, the rate at which the price changes relative to a change in market interest rates. And so that's exactly kind of the idea of what we just described. This is more, or this has more convexity because as bond yields fall, you're getting a higher acceleration in your payments or in your price. I'm trying to remember back in high school physics. You have the idea of velocity, and I'm trying to think, was that a function to describe the position? So you have some type of position function. So given, I guess, a coordinate or given some time, t, it'll give you the position of an object. If you take the first derivative of that, then that gives you the velocity. And if you take the derivative of the velocity, then you get acceleration. So I think that's a very similar idea here. Bond price, duration, yeah, the second derivative of just a straight line, or derivative of a straight line is, okay, yeah, two things here. The first derivative of a straight line is constant. The second derivative of a straight line is 0. So the first derivative of a convex function is a linear function. And I want to say the second derivative of convex function is a constant. Yeah. The first derivative of a straight line function is a constant. So let me think. Convex function doesn't necessarily mean that it's... I think the true mathematical definition is that second derivative is positive. And I don't know if it's right to say that the first derivative of any convex function is a linear function. But first derivative of I think quadratic, right, function is a linear function. So quadratic just refers to squaring a number. Yeah. So, helpful math reminders. Okay, so this is the idea of modified duration too. But now that I've kind of laid this out, I really want to go back to this. So if you take the ratio of exponents, what happens? So let's say you have something like this. Let's see, so we have x. So x1 squared plus yeah, I'm trying to think here. How should I write this? Right, so this is another way of looking at it maybe. Just get rid of the ones. Make this simple. Okay. take a ratio of exponents, right? So what did I mean by that? I think what I mean by is like, okay, 1, 2 squared divided by 5 squared, right? So if you 2 squared, so this is equal to 4 divided by 25. Okay, right? And what about, alright, so this is known. It's math. So 2 plus 1 squared okay, so divide this by 5 plus 1 squared, and this is going to be equal to, so this is 9 divided by 36. So 3 times 3 divided by 6 times 6. So this then becomes, oh, getting a call right now. Let me see.
Sorry, do you know your stream? Do you know?
Yeah, hold on, let me mute myself real quick. I don't know, how do I, oh wait, let's see. Hello, hello, hello. Okay, I think I hope I muted myself. Yeah.
You know anything about the SAVE plan, the new student loan repayment plan?
No, I don't know anything about student loans. What about it?
I just wanted to see if you know anything about it, because it seems like too good to be true.
Well, it is done by the government, right? So, unless the government is trying to scam you.
Forbearance.
Hmm? Wait, I think you should give this a try. See what happens, right? Because you have federal student loans, so doesn't hurt to try. Right? Maybe save a few grand. Yeah. Do you want to stay on the call? I'll just mute you. Or I'll mute myself.
Okay.
Yeah. Let me. Yeah, I also. Okay. I'll send you a charge my phone before it dies. Nice. Nice. Why are you wearing like a whole ass sweater when it's 100 degrees outside? What happened? Did your air conditioning start working? Wait, you said it started to work?
you turn it on, then it gets too cold. You don't keep it on 24/7.
Okay, well, when it's 100 degrees outside, you guys turn it on? That's fair. Alright, I'll go on mute. Let me... I will see ya for now. I love you.
You froze. I can see you.
I'm on mute, bro. Alright, bye. For now, I'm gonna put myself on mute. Alright, I'm back. Allison just called, so wanted to get that. But going back to the example here. Alright, this is kind of what I wanted to illustrate, right? I think we can't say that. So 4 divisible by 6? Oh, sorry, this is 1/4. 4 divided by 25. So this is actually greater. Wait, so what happens if I do this then? This is kind of like a getting off topic here, but three plus 1, 6 plus 2, so that's 16 divided by 49. Okay, so I think 16 divided by 49, this becomes, I don't think there is kind of a divisible thing here, right? But is that greater than 1/4? So what's 4 times 16? Yeah, I think that is greater than 1/4, right? Because 4 times 16 is 64. And so in order for this to be 1/4, then this would be 16 over 64. Yeah. Okay. So with that out of the way, I wanted to just show that this isn't equal to this. But this isn't really the same idea, right? Because, what if I just plug in numbers here and just see what happens? I think I might do this for, let's say 10 minutes, and then, yeah, I really gotta move on here. So let's do 1. Yeah, everything here, let's just make 1. Let's see if this works. Plus 1, plus 1. Okay. So this just becomes, so this is equal to 1/3 So 1/3 plus 1/9. Okay. Okay, and yeah, this is kind of a big fraction. I don't even know at this point. So math. This is what I want, right? So back. So 1 plus 1. So 1 divided by 1 plus 1 plus 1 divided by 1 plus 1. Squared, right? So this then is equal to, so 1/2. Yeah, we can do this. Oops. 1/2, 1/2, 1/4, right? So I'm starting to see a pattern here where it's like, all right, you're always gonna have these two match, and then the second match. So the next thing we would add is 1/4 divided by this, right? So if we divide 1/2 by 1/2, this just becomes 1. If we add a 1/4, then what does that add to this, right? Okay, I'll put a pin on this one for now again. Yeah, still kind of stuck here, but takeaway so far, yeah, the weights don't change when the yields change, and the weights add up to 1. Yeah, that's still kind of unclear here. Modified duration. So modified duration is slightly different. You take Bucola duration, and I think you divide that by 1 plus the yield to maturity, and you divide that by n. So the number of coupon payments per year. Think this number here. Yeah. And so as yield to maturity goes up, that means your duration actually falls. So there's an inverse relationship between yields and duration. I think let's take a look at this, right? As the yield falls, that means the slope of this becomes higher intuitively. So as the slope of this gets higher, then that means the velocity at which you're going it gets higher. So I think that's kind of a really big thing to make here. Yeah, I want to see though, is convexity for bond payoffs constant? Convexity on convexity formula. It is one of the most basic, right? Okay, so there's two different things here. Zero coupon bond where all of the payment is at maturity, and an amortizing bond where all the payments are front loaded. Okay, so I think what this is saying, it is convexity. So this is the bond price with respect to an interest rate R, and we're taking the derivative of this with respect to R squared. So what does that mean if we take the derivative with respect to R squared? Ooh, okay, yeah, I think this is... Yeah, this is where kind of... I think what this is, it's the MBS securities, right? So they have an embedded option here. Yeah, let me take a look at MBS price yield curve. Ooh, yeah, I think that is the second idea though, right? So how do you actually hedge this stuff? This is where it gets kind of exciting, but also a bit confusing. Okay. Yeah. Also, maybe it's worth taking a look here. Liberty Street economics. So what's Liberty Street economics? Okay, so I guess it's part of the New York Fed. Yeah, that's interesting. All right. Gamma, okay, so similar to what gamma is. Yeah, let me see what this is trying to say. Maybe ChatGPT will know. Can you explain what this formula is trying to say? Yeah, this right here is kind of confusing me. The 1 over b convexity is in terms of the modified duration d. So modified duration derivative of the price. Okay, maybe it'll be worth watching a YouTube video.
Hi and welcome back to the Business Career College video series. In this video, we're going to look at bond duration. Now this is not something you will need at the life license qualification.
Maybe this.
Next concept now is convexity. Okay. So what I want you to do is just write down one sentence which will help you understand the whole concept in one go. Okay, the sentence is: convexity is a friend of bondholder. Convexity is a friend of bondholder.
Okay.
Okay, what does it mean? It means that convexity is something which is always protecting a bondholder. So when the yield in the market increases, that time bond price decrease, but because of convexity it would decrease less. But when the yield in the market decreases, bond price will increase, bond price in each of these scenarios. So you also start doing the calculation. Now what I'll do to the origin. Now what is the meaning of convexity here now? 1,000 is, and it is helping him at 10%. Bond price was 1,000. So at 10%, bond price was 1,000. At 11%, it came out to be 913. So 11%, bond price was 913. And at 9%, bond price was 1102. So we would put the numbers in this formula. 1102 plus 913 minus 2000 divided by 2 into 1000 into 1% square.
So I guess this is the current price. It's the change in yield. It's the change in price. This guy's just breathing.
So the convexity has that is 75. Okay, now again it might look a bit counterintuitive. Imagine a scenario that this was not curved. Imagine a scenario it was a straight line. Had this been a straight line, if at 10% bond is 1000, at 9% it should be 1100, and at 11% it should be 900. So it's a perfectly linear relationship, 100 for 1%. If this happens, in this formula see what happens. 1100 plus 900 minus 2000. Convexity how much? 0. It's a straight relationship, no convexity. But here, when it decrease less. When it increase more. And therefore this number came out to be a positive number in the numerator. Correct? So find out how much. Just tell me the numerator number. So that's...
Oh, interesting. So that's an interesting way to look at it, right? So when yields change, you're going up more than when yields go down, you're going up less, right?
15 by 2, is it 7.5?
Okay, so I think this is actually... convexity. Okay, okay. Yeah, I gotta go do my laundry real quick.
Penn State is also a really fucking unusual school. Only a loser would pick Penn State. So Everton, wait, what school did Everton make again? Auburn.
Hey Josh, can I put my clothes in the dryer?
Oh, is that shit in the dryer? Yeah.
You have a later master or something?
I don't know. Imagine not knowing your own conference. Sounds like an out to me. You're an ACC. You are an ACC school. Atlantic Coastal Conference. Also true. What? He's ashamed of himself because he picked Alabama. Howard, I don't know why you allow people to pick top 25 in these schools. Like, I don't know why you do that.
Okay, I'm back. Alright. Yeah, let me maybe just write this myself. Frac. So, text effective convexity is equal to, so we could take, I believe it's the change, nabla, oh, I think that's delta y, oops, delta y, okay, so minus delta y, and, oops, wait, minus 2v how did this guy calculate it? 2 times 1,000. V times delta y squared. Right? Okay. So where math inline, so V is equal to value of bond when yields fall, rise by, oops. Where did it go? Okay. 5i. So value of bonds minus delta y fall by delta y, right? And V value of bond using an option pricing model. Today can compute using option pricing model. Value change in yield. Okay, so I think that's good. And see how to price an MBS. Option adjusted spread. Z spread. So it's swap spread. Partial differential equations. Okay, so I guess this is kind of the very complex field of volatility modeling. So volatility, I think, is probably the second part of the equation here. It's not actually directly stated, but I guess it would be helpful to understand the Black-Scholes options pricing model. I wonder if there's like a Khan Academy. Yeah, this could be very helpful.
We're now going to talk about probably the most famous formula in all of finance, and that's the
Ooh, this is
Black-Scholes
also very
formula, sometimes called the in
Okay, let me take a look at Khan Academy Finance plus Capital Markets. Right, because I remember at Khan Academy, Sal Khan, he used to be a...
what I want to do in the
Payday loans, that sounds very familiar. I think it's the idea of taking on a loan that has really high interest. This could be worth watching, so E and compound interest, right? Yeah, this is actually pretty interesting. I didn't realize how in depth this was. I didn't see the Khan Academy. Okay. Okay, so I guess this is kind of where that life of a company from birth to death. Yeah, that's interesting. Okay, wait, so Sal Khan hedge fund. Connective capital management. Me getting distracted, looking up Sal Khan on LinkedIn. Found it. Damn, this dude is crazy. He got a bachelor's in computer science, math, and a master's in just 4 years. Jesus Christ. You're gonna go shower. You're gonna go shower. Okay. Okay. Sounds good. That's cute as fuck. That's scary. Yeah, sounds good. Bye bye. Bye bye. Yeah, see ya. Okay, I'm back.
Oh, wow, you're gonna tell me about that right now. Okay.
This is interesting.
Well, you watch my friends. Sue, it's a TV show, huh? Not Nick Carter.
I want to go back to summer camp again. No. Okay, I'm not curious. Ooh, outside, okay. Yeah. What if I took this starting from right, if I start math from high school all the way to that, yeah, science, middle school biology, high school biology. I never took physics actually, so high school physics. Let's just take a look, see what this is.
Let's explore the ideas of position, speed, and velocity. So let's start with an example. We have a car parked here somewhere on the road. What is its position? So
Okay,
let's start with that.
so
What is its...
Guess then Sal Khan doesn't do everything, right? College chemistry. Let's take a look.
The thing that I've always found amazing about chemistry, it's an entire field of science that we as human beings have developed to actually understand what is happening at an almost unimaginably small scale. In particular, we're going to be thinking about the atomic and even the subatomic scale. And by looking at that scale, we can then begin to understand the universe in which we live in, the scale in which we live in, and even be able to make predictions about what will happen and make things that are useful for human being. So when you see something like this, you might have a few reactions. Your first reaction, which would be an appropriate reaction, is that, wow, 10 to the negative 27 power is very small. To appreciate it, you could write it out. It would be 0 point and then 26 zeros, and then you would have 1660540. So very, very, very small, really unimaginably small. We can only try to abstract it with things like mathematics. The other thing you might appreciate is like this feels like a bit of a hairy number here, 1.660540. Why did they define it that way? And the answer to your question is, this definition makes it a lot cleaner when we think about the mass of whether it's an atom, proton, or a neutron. And so you that have 1 or 2 neutrons, but most 90.
Before we get into the terms endo and exothermic, we need to look at some other thermodynamics terms that are used.
Okay, that's kind of crazy. Health and medicine. Bro, if I went through going through all of Khan Academy. Yeah, that actually would be like a interesting life goal. This is completely unrelated to Stonks Maxxing, but on my other channel, Intelligence Maxxing, this would be interesting to try to finish every single thing on Khan Academy. Arts and humanities, so like, all right. Yeah, okay, so this could be interesting, right? XR in a box.
Let's explore the ideas of
TX text. Math, high school and college. Okay, yeah, so that is very interesting. I think what I should probably come back to is there actually last thing I want to see is whether okay, economics, finance and capital market, so it is in there. Okay.
The last.
Oops.
Black-Scholes-Merton formula, and it's named after these gentlemen. This right over here is Fisher-Black, this is Myron-Scholes, and they really laid the foundation for what led to the Black-Scholes model and Black-Scholes formula, and that's why it has their name. And this is Bob Merton, who really took what Black-Scholes did and took it to another level to really get to our modern interpretations of the Black-Scholes model and the Black-Scholes formula. And all three of these gentlemen would have won the Nobel Prize in economics, except for the unfortunate fact that Fisher-Black passed away before the award was given, but Myron-Scholes and Bob Merton did get the Nobel Prize for their work. And the reason why this is such a big deal, why it is Nobel Prize worthy, and actually there's many reasons, I could do a whole series of videos on that, is that people had been trading stock options, or they've been trading options for a very, 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 very long time. They had been trading them, they had been buying them, they had been selling them. It was a major part of financial markets already. But there was no really good way of putting our mathematical minds around how to value an option. People had a sense of the things that they cared about, and I would assume especially options traders had a sense of the things that they cared about when they were trading options, but we really didn't have an analytical framework for it, and that's what the Black-Scholes formula gave us. But let's just, before we actually dive into this seemingly hairy formula, but the more we talk about it, hopefully it'll start to seem a lot friendlier than it looks right now. Let's start to get an intuition for the things that we would care about if we were thinking about the price of a stock option. So you would care about the stock price, you would care about the exercise price. You would especially care about how much higher or lower the stock price is relative to the exercise price. You would care about the risk-free interest rate. The risk-free interest rate keeps showing up when we think about taking a present value of something, if we want to discount the value of something back to today. You would, of course, think about, well, how long do I have to actually exercise this option? And then finally, this might look a little bit bizarre at first, but we'll talk about it in a second, you would care about how volatile that stock is. And we measure volatility as the standard deviation of log returns for that security. So that seems very fancy, and we'll talk about that in more depth in future videos. But at just an intuitive level, just think about two stocks. So let's say that this is stock 1 right over here, and it jumps around, and I'll make them go flat just so we make no judgment about whether it's a good investment or so. You have one stock that kind of does that, and then you have another stock. So I'll draw them on the same. So let's say that is stock 1, and then you have stock 2 that does this, It jumps around all over the place. So this green one right over here is stock 2. So you can imagine stock 2, just in the way we use the word volatile, it is more volatile. It's a wilder ride. Also, if you were looking at how dispersed the returns are away from their mean, you see the returns have more dispersion. It'll have a higher standard deviation. So stock 2 will have a higher volatility or a higher standard deviation of logarithmic returns. And in a future video, we'll talk about why we care about log returns. And stock 1 would have a lower volatility. So you can imagine options are more valuable when you're dealing with, or if you're dealing with a stock that has higher.
Okay, yeah, let me. So now we're delving into the world of options, which isn't really super related to bond duration convexity, but I think plays a very close, or is very similar in the sense that you can have bonds that do have embedded optionality to refinance, kind of like this MBS security right here. So So higher volatility, well, for an underlying stock price, and make security price will make the option more valuable.
volatility that has higher sigma like this feels like it would drive the value of an option up. You would rather have an option when you have something like this, because look, if you're owning the stock, man, you have to go after this is a wild ride. But if you have the option, you can ignore the wildness, and then it might actually and then you can exercise the option if it seems like the right time to do it. So it feels like, if you were just trading it, that wow, the more volatile something is, the more valuable an option would be on that. And so now that we've talked about this, let's actually look at the Black-Scholes formula. And the variety that I have right over here, this is for a European call option. European call option. We could do something very similar for a European put option.
The idea is that you have a greater chance that you can reach option will be in the money because price tends to move a lot. As an option holder, the downside risk is limited to the premium.
So this right over here is a European call option. And remember, European call option, it's mathematically simpler than an American call option in that there's only one time at which you can exercise it, on the exercise date. On an American call option, you can exercise it.
Okay, so that's important. So European call options, American call options can only exercise at maturity, can exercise at any point in time. Before maturity, right?
At any point. But with that said, let's try to at least intuitively dissect the Black-Scholes formula a little bit. So the first thing you have here, you have this term that involves the current stock price, and then you're multiplying it times this function that's taking this as an input, and this is how we define that input. And then you have minus the exercise price discounted back. This discounts back the exercise price.
Price a European call option using the Black-Scholes model. We do the following. Oh, alright, so C0 is equal to 0 normal D1 minus X E raised to the negative RT and D2 where math S0 is equal to stock price X, oops. Price T is equal to time 2x duration. Exercise price. Math. I keep adding these blocks. Do not want these blocks. Delete. Delete. Okay, slash inline. Oh, math. Okay, and then we have our risk-free rate.
Times that function again, and now the input is slightly different into that function. And just so that we have a little bit of background about what this function n is the cumulative distribution function for a standard normal distribution. I know that
Cumulative distribution function, okay. So there's the probability density function and then cumulative distribution. So I think it's the probability that you observe any value that's less than, I guess in this case, x.
cumulative distribution function for a standard normal distribution. I know that might seem a little bit daunting, but you could look at the statistics playlist and it shouldn't be that bad. This is essentially saying for a standard normal distribution, the probability that your random variable is less than or equal to x. And another way of thinking about that, if that sounds a little, and it's all explained in our statistics playlist if that was confusing, but if you want to think about it a little bit mathematically, you also know that this is going to be, it's a probability. It's always going to be greater than 0, and it is going to be less than 1. So with that out of the way, let's think about what these pieces are telling us. So this right over here is dealing with it's the current stock of the price, or it's the current stock price, and it's being weighted by some type of a probability.
Remember, this is a probability between 0 and 1. Okay.
And so this is essentially one way of thinking about it in very rough terms is this is what you're going to get. You're going to get the stock, and it's kind of being weighted by the probability that you're actually going to do this thing, and I'm speaking in very rough terms. And then this term right over here is what you pay. This is what you pay. This is your exercise price.
Okay, so it's breaking down the Black-Scholes model in rough terms.
Price discounted back, somewhat being weighted, and I'm speaking once again, I'm hand waving a lot of the mathematics by, look, what's like, are we actually going to do this thing? Are we actually going to exercise our option? So that makes sense right over there, and it makes sense if the stock price is worth a lot more than the exercise price, and if we're definitely going to do this, let's say that D1 and D2 were very, very large numbers, we're definitely going to do this at some point in time.
So this actually kind of reminds me of, yeah, this is like continuously compounding interest rates, but it's a discount factor. So you're discounting the strike price in the future, right? And maybe the probability of doing so.
Then it makes sense that the value of the call option would be the value of the stock minus the exercise price discounted back to today. So this right over here, this is the discounting, kind of giving us the present value of the exercise price. And we have videos on discounting and present value if you find that a little bit daunting. And it also makes sense that the higher the stock price is, so we see that right over here relative to the exercise price, the more that the option would be worth. But it also makes sense that the higher the stock price relative to the exercise price, the more likely that we will actually exercise the option. And you see that in both of these terms right over here. You have the ratio of the stock price to the exercise price, ratio of the stock price to the exercise.
Okay, so that's, yeah, very helpful. Oh, okay. Let me just take a few seconds just to kind of let everything settle, marinate. Okay. Yeah, let's go back to this. Okay, so breaking down. So math. Oops, I don't want this. All right. Math. Okay, so this is equal to the. So what you're getting from the call option. So note that math oh shoot math is can be interpreted as the probability that you're getting the stock the underlying security will be worth math so as 0. Okay. So it is thought of as a weight. Okay. What you're paying for a call for the call option. Is the present value of the strike. X discounted by continuously compounded discount factor. Math. Right. So again, we can think of as the probability / weight. Okay.
price. We're taking the natural log of it, but the higher this ratio is, the larger D1 or D2 is. So that means the larger the input into the cumulative distribution function is, which means the higher probabilities we're going to get, and so it's a higher chance we're going to exercise this price, and it makes sense that then this is actually going to have some value. So that makes sense, the relationship between the stock price and the exercise price. The other thing I will focus on, because this tends to be a deep focus of people who operate with options, is the volatility. So we already had an intuition that the higher the volatility, the higher the option price. So let's
so Black-Scholes model. Graph. There was like a nice cumulative distribution thing I remember seeing. Yeah, I think this was it actually. But I don't know, I'm not entirely sure.
Let's see where this factors into this equation here. So we don't see it at this first level, but it definitely factors into D1 and D2. So in D1, the higher your standard deviation of your log returns, so the higher sigma, we have a sigma in the numerator and the denominator, but in the numerator we're squaring it. So a higher sigma will make D1 go up. So sigma goes up, D1 will go up.
Yeah,
let's think about what's happening here. Well, here we have a sigma. It's still squared. It's in the numerator, but we're subtracting it. It's growing. This is going to grow faster than this, but we're subtracting it now. So for D2, a higher sigma is going to make D2 go down because we are subtracting it. So will this actually make, can we actually say that this is going to make, a higher sigma is going to make the value of our call option higher? Well, let's look at it. If the value of our sigma goes up, then D1 will go up. Then this input goes up. If that input goes up, our cumulative distribution function of that input is going to go up. And so this whole term is going to drive this whole term up. Now what's going to happen here? Well, if D2 goes down, then our cumulative distribution function evaluated there is going to go down. And so this whole thing is going to be lower, and so we're going to have to pay less. So if we get more and pay less, and I'm speaking in very hand-wavy terms, but this is just to understand that this isn't as intuitively daunting as you might think, but it looks definitively that if the standard deviation of our log returns, or if our volatility goes up, the value of our call option, the value of our European call option goes up. Likewise, using the same logic, if our volatility were to be lower, then the value of our call option would go down. I'll leave you there. In future videos, we'll think about this in a little bit more depth.
Okay, so I think
I'll leave you there.
Probably good. Okay, so now that we've broken it down, so hand wavy effects of volatility. Okay. So D1 is equal to, alright, so we have ln of, so stock price and our exercise price, and then we also add oops, sigma squared. Divide that by 2. Don't know where that's coming from, but we have r plus t sigma square root of t quad so d2 is equal to ln. So it's the same thing, but in this case we subtract times t. And okay, so it's the same exact thing actually, except we just flip the sign here. Notice that in the Black-Scholes formula, the only terms affected by volatility, so sigma are the terms math d1 and d2. Okay, so this is important. When sigma increases, then the d1 term increases, and the because the sigma d1 we are adding sigma squared, while in d2 we are subtracting sigma squared. Term decreases because in d1 we are adding sigma squared, while in d2 we are subtracting sigma squared, right? Okay. So let me see real quick. Is there a private equity pacing model? Yeah, just interested in looking at this real quick. Okay. Alright, getting a call real quick. Let me mute myself. Yo, yo, yo. Yo, yo, yo. Cute, cute, cute. Oh my, oh my. Alright, I am still streaming. Oh, fuck. You better go to sleep.
I'm gonna lay in bed.
Okay. Is it okay if I mute myself for a little bit? I'm deep in thought.
Maybe what?
Is it okay if I mute myself for a little bit? I am deep in thought.
Just call me back. My
Sound.
phone's gonna heat up.
Okay, sounds good. Oh, see ya. Bye. Bye.
Bye.
Bye. Alright, so when sigma increases, see above formula. Okay. This effectively makes the right. Let's see. Term worth more because and this term represents what we roughly represents what we are getting from the call option, and be worth less. Since what we are paying for the call option because what we are getting is increasing and what we are paying for is decreasing, the overall value of the call option increases. Okay, yeah.
There. In future videos, we'll
It's good.
video, we already got an overview that if you give me a stock price and an exercise price and a risk-free interest rate and a time to expiration and the volatility or the standard deviation of the log returns, if you give me these 6 things, so if you give me these things, 6 things, I can put these into the Black-Scholes formula. I can put these into the Black-Scholes formula. Me these 6 things. So if you give me these things, 6 things, I can put these into the Black-Scholes formula. I can put these into the Black-Scholes formula. So Black-Scholes formula, and I will output for you the appropriate price for this European call option. So it sounds all very straightforward, and some of this is straightforward. The stock price is easy to look up. The exercise price, well, that's part of the contract. You know that. The risk-free interest rate, there are good proxies for it. Money market funds, there's government debt, things like that. So that's pretty easy to figure out, or at least approximate. The time to expiration, well, you know that. You know what today's date is. You know when this thing's going to expire. So that's pretty straightforward. But now let's think a little bit about volatility. So how do you actually measure the standard deviation of log returns? Now, one of the assumptions about Black-Scholes formula is that this is a constant thing. This is just some intrinsic property of this security. Well, the only way that you can at least attempt to estimate it is by looking at the history of the standard deviation of log returns. So the way that people would normally do it is, well, they'll say, okay, what has historically been the standard deviation of log returns over some time period where that security has not changed in some dramatic way, and then use that as the input, and then they would come up with some price. Well, that's all interesting, but it's very important to know that this is an estimate. This right over here is an estimate. There's no way of us actually knowing the actual intrinsic, and it's even up for grabs whether you can even assume that there's some constant intrinsic property as this volatility that's going to be constant over the life of this option. So this is just an estimate. It's important to know that. But what is interesting is that these things are being traded. These call options are being traded all of the time. And so you could actually look up the price of this call option. You could look up a call option with this stock price, this exercise price. You know what these two things are. And you could say, hey, look, this traded for $3 just now. So you actually can figure out what this is. Which raises a very, very interesting question. If you know exactly what this is, because you know what the market is pricing, up a call option with this stock price, this exercise price, you know what these two things are, and you could say, hey, look, this traded for $3 just now. So you actually can figure out what this is. Which raises a very, very interesting question. So if you know exactly what this is, because you know what the market is pricing this at, so let me write this. So you know what the market believes this price should be. So the market belief, and it's based on their actual transactions. So it's based on transactions. So this is what the market is saying the correct price is. So you can figure that out. You can just look that up. You can figure out all of this other stuff. Can you then take this output plus all of these to work backwards through Black-Scholes to figure out what the market is guessing about this, or what the market is estimating about that? And the answer is yes. And this is where this whole idea about when people talk about what is the volatility in the market, or even where are current volatility rates, or what does the market expect volatility to be? Well, how do we know what the market expects volatility to be? Well, we can look at what markets are trading options at, and we could look at all of this other.
How is implied volatility calculated?
He's not gonna have a good time. Well, I suppose so what?
Quant exchange.
I hate Logan. What? Okay, Julie, that is not the response that I was looking for.
Geometric Brownian motion. Okay. Wow, so this kind of all ties back together with everything. I remember learning about geometric Brownian motion back in, I think, a few semesters ago, 2 semesters ago. It's very shaky and hand-wavy. I only know high-level concepts, right? So I think it's the exponentiation of a Brownian motion, which is the idea of random fluctuations in stock prices, almost maybe like a random walk, but the increments of the process, so it's something that happens through time, are completely independent of the previous steps. Wow. I'm so fucking sad. I want to take this class with Steve Heston, who's a teacher. Oh my god. I have no idea what I'm reading here. Gambling related research.
Oh my god, this pissed me off, bro. It's not like you're a fucking closeted fucking pedophile. It's like you watch a Japanese TV show. Yeah, but he was talking about anime like he was talking about it like it's a drug addiction. It's just a fucking Japanese TV show. It's not that deep. What? Wait, what context is there that he's...
Huh.
With all due respect, that's statutory rape. Like, what context? Oh, so she's retarded.
304 pages.
That's not better. Wait, okay, see, I'm confused now. Okay, she was... That's so disgusting. With all due respect, it's like... Dude, what? Wait, Carter, was her frontal lobe not there? Was she like deformed? Yeah, okay. So she was like disabled? Joe just... Shit. Oh my god, that's... Dude. Joe's preying on the fucking broken ones. Honestly, Angela, Joe picks him right. That's really problematic. Carter.
Okay. UMD schedule classes. PFN.
Yeah, this is a crazy day for Julian. This is a crazy day for Julian, not gonna lie.
Shoot.
Yeah, but you know that they, just didn't get it. Just didn't get it.
It's at the same exact time. Why?
Oh, dude, that's funny.
Damn.
Is his Spanish good? Like, is he confident speaking, or is he like broken?
Oh, maybe I could take this. Yeah. That's not very long, though. Oh, wow.
So you just had him get cooked. You were confused. Oh, boy. Julian's on with it. This is Julian's hot right now. He's cooking.
Yeah, maybe I'll ask if I can join his. Oh, shoot, it is closed though. Fuck. Oh, yeah, but there's 0 people. I don't know what's going on with that. Okay, so implied volatility, basically whatever you're getting out of
Other
this.
information that would be inputted into Black-Scholes equation, and we could say, hey, look, based on the fact that the market is paying $5 for this option and all of these other variables, they must assume that the standard deviation of log returns for this security is now this. Now let's say that things get really scary, the market becomes a lot dicier and choppier. Well, then people are going to pay more for this option. It's going to drive the implied volatility up. So when you hear people talk about implied volatility or implied vol, and there are even people who will actually trade on implied volatility. So implied volatility, this is what they're talking about. They're saying, look, options are trading all the time. Can we use that price, the market belief of what those prices should be, and then work backwards through Black-Scholes to figure out, because we know
Is found by working backwards through Black-Scholes. the
No, these are all facts. We can look these things up, but based on what the market is trading these options at, can we figure out what the implied volatility, what the implied market belief about volatility for that security is, and then we can actually aggregate it across many securities and come up with an implied volatility for given markets at a time. So it's a very implied volatility. And then we can actually aggregate it across many securities and come up with an implied volatility for given markets at a time. So it's
yeah, I'm gonna using the current market price of an option.
It's a very interesting idea, but in some levels it's kind of a basic one. You're just working backwards through Black-Scholes.
Okay, well, this guy never really went into log returns used. Stock 0 plus from 0 to t, so r times stock 0 to t, standard deviation. Okay, so it's equal to R times stock price change in time plus sigma times, what's W here? So if you take the divided by, okay, okay, that makes sense. Take the log, so divide this, take the log of that, take the log of this, it becomes this. Okay, so I think with that being said, this is probably where I'm going to end it for today. My mind is starting to be a little bit fried, so yeah, I think it's time to call it here. But thanks for tuning in, and catch you guys in the next stream. Peace.